So good night everyone, it's great to be back at the Property Investors Meetup, and thanks again to Sumit and everyone else for having me back this month. There's a couple of things that we thought would be great to share with you, and we've been doing this across all of the networking events that we've been attending throughout the month, because we feel that there's a lot that comes up on social media, and so many people nowadays want to perhaps look at a few more creative ways of financing properties than the bog standard 25% deposit, 75% mortgage. So hopefully we can share a little bit of a strategy around that tonight to give you something to consider that may work in your own background. So who are we? Well, we're Harvey Bowes. We're a mortgage brokerage based in South Wales of all places, but we are known across the country for the work that we do with property investors in HMO finance, development finance, bridging finance. We do a lot with standard buy-to-lets as well as multi-unit blocks, holiday lets, and essentially anything to do with commercial property as well. So if you do require any assistance, please feel free to contact us or to contact us via Sumit. Either is absolutely fine. You'll see the website address at the very bottom of each slide, but you'll also see our contact details at the very end. Now, if you do have any questions, please feel free to reach out or to get in touch, and we'll talk those through. And if you want to look at this particular idea in a bit more detail, more than happy to go through that when you've got a bit more spare time yourself. So for tonight's talk, we want to look at this. So people on Facebook say, I can get 100% finance. Now, I reckon tonight there's going to be a mixed bag of people at this event that are going to say, yep, totally agree with that, absolutely doable. And there's going to be others that go, well, I'm pretty sure lenders are only lending up to about 75% at the moment, so no, I don't think it is possible. Well, for the sake of this particular presentation, I can assure you that it is absolutely possible. Now, you don't necessarily have to have a portfolio in the background, but you will need a few things to make this work. So let's have a look at the process and see how we can do this. So first of all, you're going to need the property that you're looking to purchase. Second of all, you're going to need a property in the background with some equity in it. And then finally, you're going to need the right lender and the right broker to make this transaction happen. Now, you might have seen the centre of the screen, we've now also got something else next to our part talking about the property with equity. Now, it doesn't necessarily need to be yours. Now, this is where it gets a bit more interesting. This theory works with a family member's home, if you've got a business partner, or even if you've got business premises. This sort of situation can work with a lot of lenders. So if there's a property in the background that you're working with, you can generally utilise that. So for the sake of this illustration, tonight we're going to base this on that idea that we need a 25% deposit and we're going for a 75% loan on this new property. Now, I'm going to be honest, this works really well in South Wales, but I can imagine in London this probably doesn't get you a huge amount, if anything. But just use this more as a concept, because the concept works really nicely. And you can replace these figures with your own, and this is definitely something that can work. So we're going to say, for the sake of this, that our purchase property is going to be valued at £150,000. Now, the property that we have that equity in, we're going to just, for argument's sake, say that it's worth £100,000 and then it is currently unencumbered, which basically means it has no mortgage on it at all. So let's look at the numbers on that. If we were going for a 75% loan, our loan would be for £112,500. Now that means that our 25% deposit is going to work out to be £37,500. Now it may well be that we're not cash rich, but it might be that we're asset rich. In this case, this is how we can make it work. Essentially, the lender is going to do two things. First of all, it's going to grant that loan for £112,500, but it then takes first charge of the property that has that equity in it. Now, this is also referred to as a cross charge. So the lender is taking an interest in the property that you own in the background, or that you have access to in the background, and registers their loan against that property, and then uses that interest to put towards the deposit of the new property. So that means that your purchase of 150,000 is made up of essentially two securities: the loan tied against the new purchase property, and the deposit taken from the loan against your existing property. So that's how you make it work. That's how you get 100% financing. Now, as we said, it doesn't have to be your property. It could belong to a family member. It could belong to a JV partner. But ultimately, this is a great way, and we've done this loads of times at Harvey Bowes. You can raise capital from background assets, and this will then give you the deposit to go and buy property. So one of the biggest things we find on the network across the country is that a lot of people want to get into property, but they don't necessarily have the cash available to do it, which is why you see a lot of people talking about things such as deferred consideration, lease options, the creative list goes on. But this actually isn't too taxing. And I know that obviously we've gone through a lot of information in a very short period of time, but it's a wonderful way of getting that money together. Now, you may be asking yourself that question now. Well, I don't have a property that's unencumbered. All of my properties have got mortgages on. So can I still make this work if there's a mortgage on the property? And the answer is yes. And in fact, this gives you a couple of additional options. Now, if you've got a property with a mortgage on it, now this generally works better if you have a very low loan to value, or we often refer to it as being lowly geared. So a lot of lenders will do what's known as a further advance. So this means that if your affordability allows, if it's a residential property, or if the rental income stacks up against the loan amount, you can take additional money from that property and then use that as a way of putting a deposit down on a further investment. You don't have to completely refinance. I think there's this whole myth that you have to refinance every time to take money out. You don't strictly have to do a whole refinance. A further advance will just allow you to get up to the lender's maximum loan to value against the rental income, or if it is your residential property, then the maximum loan available against your affordability. So this can work really nicely. Now, the other way of doing this as well is utilising something that's called a second charge. Now, a second charge is generally where an additional lender comes on board to give you a loan and take your property as security. Now, for a second charge, let's just say you've got a lender like Kent Reliance in the foreground. They're your first charge lender. And then another lender such as, let's say, Together, they would then say, right, well, you've got a mortgage with Kent Reliance. We want to take some additional money out. We can do that. We will register our interest on a second charge basis and give you that loan so that you can go and buy this new property. Now, you might ask the question, well, what's the difference between a first charge and a second charge? And if you know the answer to that, I apologise if I'm going into more detail than's needed, but it's good to clarify these things. A first charge lender is registered against the property so that if anything was to happen, let's say you defaulted on your loans and they had to repossess it, then they would get the first interest. So ultimately, if the property had to be sold, any money gained from that sale would go to pay off the first charge lender first of all. If you've got a second charge lender in place, that means that that particular lender will be second in line to get paid off if that property had to be sold. So it's really just a case of who has the rights to the first amount of money, if it had to get sold. And if the loan gets paid off, your first charge lender would be first, the second charge would be second. So I really hope that's kind of given you a couple of things to consider, because I think this is a great strategy. And if you are fortunate enough to have a portfolio in the background or access to another property, then this could work really, really well for you. So please feel free to get in touch, harveybowes.com, or you can email me on grant@harveybowes.com. Alternatively, if you just want to give us a call and talk through some of these sort of ideas and strategies in a bit more detail when you've got a bit more time, please feel free to contact me on 029 2175 4150, and you can talk to me at any time. I'll always make some time available for that. But I hope that's provided some insights into how we do things at Harvey Bowes and some of the strategies involved. And I hope you enjoy the rest of your evening. And I'll hand back to Sumit. Sumit, thanks ever so much.